All right, let's say a big pile of cash just landed in your lap. Maybe it's an inheritance, a bonus, maybe you sold your company. Fantastic. But now comes the big question, the million-dollar question. What do you do with it? Do you jump into the market all at once, or do you dip your toes in a little at a time?
I mean, this is the classic dilemma, isn't it? Your head is telling you to get that money working to maximize your returns, but your gut is screaming, what if I invest it all right before a massive crash? So what's the smartest move? What do the numbers say we should do? And what does our own psychology tell us is the safest thing to do?
So here's how we're going to tackle this. First, we're going to look at the case for going all in. Then, we'll hit the argument for taking it slow. And finally, we're going to settle this debate between your head and your heart to find a path forward that actually works for you. Okay, let's start with the cold, hard math. This is the argument for what's known as lump sum investing. Think of this as the logical, rational, spreadsheet-driven side of your brain talking. And the data is just incredibly clear on this. Study after study, including a big one from Vanguard, shows that investing all your money at once has beaten spreading it out over a year about 2/3 of the time. And it kind of makes sense, right? Over the long haul, markets tend to go up. So the sooner you're in, the better your odds.
And just so you know, this isn't some weird fluke that only happens in the US market. Look at this. It's pretty much the same story everywhere. The UK, Australia, Canada, Europe. The numbers consistently favor getting your money in the game as fast as you can. The math just doesn't lie.
So how much does waiting actually cost you? Well, that difference in the annualized return comes down to one thing: cash drag. It's a fancy term for a simple idea. It's the opportunity cost of having a big chunk of your money sitting on the sidelines, earning practically nothing, while the market just keeps climbing without it.
Now, this is the slide that should really get your attention. It shows the biggest danger of waiting. See, a huge chunk of the market's total return comes from a tiny number of really good days. Look at these numbers. If you were fully invested, you got almost 12%. But if you just missed the 10 best days, your return drops by a lot. And if you missed the 30 best days, your return got cut by more than half. Waiting to invest just makes it more likely you'll miss one of those explosive days that you just can't afford to miss. So, if the math is so overwhelmingly in favor of going all in, why is this even a debate? Well, because investing isn't done by robots. It's done by us, human beings, with all of our fears and emotions. And that brings us to the other side of the coin, the argument for caution, also known as dollar-cost averaging.
This chart really nails the trade-off. It's your head versus your heart. Your head is obsessed with maximizing that final number. But your heart is all about minimizing that horrible feeling of regret. You know, the kind of regret you'd have if you invested your entire life savings the day before the market tanks.
And the big psychological reason for this is something called loss aversion. Behavioral economists like Kahneman and Tversky figured this out a long time ago. For pretty much all of us, the pain of losing $100 feels about twice as bad as the pleasure of gaining $100. We are literally hardwired to hate losing.
And this quote just says it all, doesn't it? When you're sitting on a windfall, that money feels different. It feels precious. Your first thought isn't, how can I double this? It's, how can I make sure I don't lose this? Dollar-cost averaging feels safer because it's a built-in insurance policy against that worst-case scenario, that nightmare of going all in at the absolute worst possible time.
And that feeling of safety, it's not just a feeling. You can see it in the data. Yeah, dollar-cost averaging usually gives you a lower return over time, but it can give you a smoother ride. What we're looking at here is the max drawdown, the absolute worst loss from top to bottom during a downturn. And you can see DCAs soften that blow. For a lot of people, giving up a little bit of potential gain is a price they are more than willing to pay to make the worst-case scenario feel less terrifying.
Okay, so we've got a clear winner on paper and a clear winner in our gut. The head is yelling, invest now. The heart is whispering, go slow. So who's right? Let's bring it all together and get to a verdict.
And here it is. This is the absolute most important takeaway. Mathematically, lump sum investing wins. It's not even close. But, and this is a huge but, that is completely and totally irrelevant if you can't emotionally handle the risk. If watching your portfolio drop 20% right after you invest would cause you to panic and sell everything at the bottom, then the so-called optimal strategy just became the worst possible one for you. At the end of the day, the best investment plan is the one you can actually stick with through thick and thin.
Now, the great news is that this isn't a black or white, all or nothing choice. You don't have to pick between your head and your heart. We can find a middle path that satisfies both.
This is where a hybrid strategy comes into play, and it's what a lot of pros do to balance not just the returns and the risk, but also to manage those very human emotions we've been talking about.
So what does this playbook actually look like? It's a pretty straightforward 4-step process. First, you immediately invest the less scary parts of your portfolio, like your bonds and cash. Step 2, you put a good chunk of your stock money, say half to 60%, to work right away. That gets you in the game and cuts down on that cash drag. Third, you invest the rest of the stock portion over a pretty short period, like 3 to 6 months. And fourth, and this is maybe the most crucial part, you automate the whole thing. Set it and forget it. That way, you take your own emotions out of the driver's seat.
So, it all comes down to this one very personal question. The numbers can tell you about probabilities, but they can't tell you how you're going to feel. The key is to be honest with yourself. Are you trying to squeeze every last drop of performance out of your portfolio, or are you just trying to build wealth in a way that lets you sleep at night? There's no wrong answer, but the right plan for you depends entirely on what you're really optimizing for.